It feels right, but it also feels wrong. And so what I mean by that is that I think it's a probabilistic weighted thing. And so the way I view it is that I think Jay Powell shouldn't cut rates today, right? If we look at the latest inflation data, it is starting to tick up a little bit. When you dig into core goods, you start to see some of that tariff pressure appears to be building. Again, it's 1 month, so we won't make a big deal of it yet. But we do think inflation has bottomed for the year. Take a look at break-even spreads, right? The market participants have started to put that in the 1 and 2 year kind of break-evens in a tips market. So when you start to look at where the market is pricing, they're asking about, they're pricing cuts, but they're also pricing higher inflation. And so when I think about Jay Powell and what he said over the last few meetings, right, he's focused on the labor market, right? Because the inflation data isn't supportive of the rate cut yet either. And so I think you would have to see degradation in labor. So when I say it feels right, it's kind of like on the basis of, well, if they have to cut because there's erosion in labor and a weakening economy, and maybe on that side you get to that kind of 50 basis points. So right now we're kind of playing for no rate cut today, but then you have this concept of the shadow Fed, right? What happens on that? And that was floated last week, and that you see how the bond market reacted. It did not like that whatsoever. And so there's been a lot of headlines about trades to put on for that. We have one on as well. We have the same trade everybody's talking about.
Tell us about it. What is that trade?
Well, it's in DB&D, is inside of there, and it's called a steepener trade. So we're long the 2 year and short the 10 year just to play that trade. Now, why would you do that? Well, if you think about the idea, I say no rate cuts. Why do I own the 2 year if there's no rate cuts? Well, let's say, for instance, that someone gets floated out because they get recommended as the new chairperson. They get active on, I don't know, Truth Social, X, whatever that may be, and they start to pound the narrative of lowering rates. One, does that pressure Jay Powell to lower rates? Potentially. Not sure. We'll have to see how that plays out. But more importantly, the market's going to look through Jay Powell's tenure and say rate cuts are coming as soon as a new person comes in. So that kind of puts pressure there. But we're still talking about inflation. We're talking about tariffs. You're loosening monetary policy while you have that. It probably leads to a steeper yield curve as well. So there's a lot of conflicting signals in the Treasury market. So you saw how many that we own a fair amount of Treasuries. They tend to be in that kind of front end or belly of the curve. We have a little bit for some protection out there, but we've been really wholesaling, ignoring the 30-year part of the market, and we think that part of the market is rife for still more pressure in rate movement upward.
Well, I want to talk about what the catalyst would be there, because I hear what you're saying when it comes to the front end. Basically, 2 year yields fall in anticipation of someone else coming in, but it feels like the long end, the 10 year, the 30 year has been pretty unpredictable as of late. And you think about the steepener trade, that's been breaking hard for years now. But
it's all about timing, right? And so, look, we put it on in 2022, we took it off. It wasn't working, it's costly to do, but it's getting less costly. Now, the problem you have now is because the Fed hasn't cut rates, you got to borrow at SOFR in order to do that trade, so you kind of have a little bit of a negative carry. But ultimately, it's paid off. We've had it on for roughly about 9 to 10 months now. We still like it because it helps provide some protection, right? So it's not that we're doing it in massive size to say this is the one trade, it's a one-trick pony in the portfolio. It's a key element there. Further, we own a lot of short duration credit. If rates come down that side, those bonds will rally as well. So there's exposure in the portfolio two ways. But ultimately, if you look at treasuries, they've been very range bound, right? And really range bound, I'll even go back to really, let's say, like the fall of 2022. The 30 years been having trouble breaking above 5%. It's done it for a couple of days. That seemed, we had a big auction, market came in. I think people are trading it though. And to me, I don't like the trade. It's very volatile, right? It's very risky, I think, in that standpoint. And by the way, we haven't even talked about the fiscal elements, right? I mean, for all this talk about Doge and, we're going to cut government spending, I don't know, I saw something about we raised the debt limit by $5 trillion. That sounds to me that they're ready to spend more and more. So I think that you have all this together. You have the Japanese market too. We had the elections, yesterday. So there's just a lot of pressure in sovereign debt globally. And so I think that's why you're seeing what you call unpredictable in the Treasury market on that back end of the curve today.
Is it perhaps just safer to count on a rate cut on June 17, 2026, because that will be after Jay Powell has left, his term has ended for sure?
But why bet on that today, right? And so here's the other thing. So why do we need to take a bet? right? Why don't we own things that are stable, that earn income? So you look at the dividend yield on something like DB&D, we're close to 5.5%. It's about between 5.25 and 5.5. Those are the bonds we're buying today. And they have short lives, right? So they're going to pay us that cash flow. They have pretty good predictability. And one thing we're trying to manage right now is volatility. So this isn't a market, to me, when we look at valuation, where we need to stretch, that we need to go out and take meaningful risk because you're not really being paid for it. And like you said, it's unpredictable on the rate cuts. So, what happens if there is no rate cut, right? Then you want to own very front-end assets. So we have some floating rate debt that does that too. So when you start to really dig through the portfolio and you look at the construction, there's a lot of things that have an interplay across them, and we're trying to bring stability to investors today. And that's what DB&D was designed to do, and it's designed to go anywhere as well. And look, we've been talking about the non-dollar trade and those type of things too. And look, those will enter the portfolio at some point this year.